Hi everyone, welcome back to my channel. In today's video, we are going to tackle question 1 from the May-June 2024 accounting paper variant 2.2. This question focuses on key concepts like prime entry books, disposal of non-current assets, inventory valuation, and accruals and prepayments. Whether you're revising for an exam or just brushing up on your accounting knowledge, this video will help you solidify these essential topics. So let's get started. First, the question gives us some information, and then they're asking us in part A to calculate the amount required to restore the petty cash interest on 1st May 2024. So what is a petty cash book? Petty cash book records the transactions that occur relating to small cash amounts. Let's go back to the question. The question says that the interest amount is $150, and also there are some payments and a receipt, which is a refund for damaged stationery of $15. So how does the interest system work? The interest system ensures that the business will have the same starting amount each period. So in this case, $150. So let's see how it works. So going back here, let's calculate the total payments. You simply have to sum up the values that were given. So 21 plus 47 plus 44 is $112. And the total receipts, there was only one refund, which was $15. Initially we had 150, out of which we paid 112, and there was another receipt of $15. Then the balance you get is 53. But we should bring this back to 150 in the next period. So on 1st May 2024, we need to restore the petty cash interest. So to this 53, we will have to add some amount in order to get 150. That's what we are doing now. We need to find that missing value. So that's simply the amount required to restore the petty cash interest, which is 112 minus $15. That is 97. So if you add 97 to 53, you will get 150. Simple as that. Part B, it's a theory question. The petty cash book is one of the books of prime entry. Part 1, they're asking us to give one other book of prime entry. So there are many. So you can say something like sales journal or purchases journal, sales returns journal, anything like that. To this list, you can also include the cash book. It's a ledger account and also a book of prime entry. So you can write that as well. Part 2, they're asking us to give 2 advantages of using books of prime entry. So one important advantage is that books of prime entry, if you take for example the sales journal, in the sales journal you list the credit sales for the period and you sum it up and then transfer that total to the sales account. So that means the amount of entries in the sales account is minimized as a result. So it helps in summarizing. Another advantage is it helps in segregation of duties. That means you can divide tasks, the bookkeeping tasks, among employees. Moving on. Part C, we are supposed to calculate the accumulated depreciation. Now remember, the accounting year ends on 30th of April. Here we are given some information about a motor vehicle that was sold. Right, let's go through the information. On 30th April 2024, Lottie sold a motor vehicle for $6,000 on credit to Y Limited. She had purchased the vehicle on 1st May 2021 for $12,000. Lottie charges depreciation on vehicles at 25% using the reducing balance method. No depreciation is charged in the year of disposal. When you get a question like this, I advise you to draw a timeline. So something like this. So the question says that the motor vehicle was bought on 1st May 2021, which is a start of an accounting period. And then the next accounting period starts on 1st of May 2022 and the next one 2023, 1st of May. And that accounting year ends on the 30th of April, the day on which the asset was sold. So we have a perfect timeline like that. Now, when we are calculating depreciation, remember it's reducing balance method, so we are charging depreciation on the net book value. For the first year, we have to charge depreciation. It's 1 full year. Since it's the first year, we will charge depreciation on the cost. So 12,000 times 25% is going to be $3,000. Then for the next year, there is another full year that also we have to charge depreciation. So then that's going to be 12,000 minus 3,000 because it's net book value times 25%. So 9,000 times 25% will be 2,250. And the last year, from 1st May 2023 to 30th April 2024, we will not charge depreciation because the question clearly states that depreciation is not charged in the year of disposal. So then we can sum it up to calculate the accumulated depreciation, which will be $5,250. Okay. Part 2 is asking us to prepare the disposal of motor vehicles account. Remember, when we are disposing a motor vehicle or any asset, we have to remove the cost and the accumulated depreciation of that relevant asset. So here we have the motor vehicles account. The motor vehicles account will generally have a debit balance because it's an asset. Now we have to remove that asset because we are selling it, so then we will pass a credit entry in the motor vehicles account, and the opposite account will be the disposal account. Then we can do that. So on the 30th of April 2024, we are going to sell the motor vehicle. So saying motor vehicle, we will debit its cost, $12,000. Then we have to remove the accumulated depreciation from the provision for depreciation account, which will have a credit balance because it's a contra asset account. So we have to remove it. So then we will pass a debit entry. And the opposite account will be the disposal account. So we will credit the disposal account. And we have already calculated the accumulated depreciation. So on the 30th of April 2024, saying provision for depreciation, we will credit 5,250. The motor vehicle is sold to Y Limited on credit. So Y Limited is a receivable, which is an asset. So we debit that, and the opposite account is going to be the disposal account. So we credit it. Saying Y Limited, we will credit 6,000 because it's sold for 6,000. So we can add up both sides. If you take the debit side, there is a total of 12,000, whereas credit side, the total is going to be 11,250. So as you can see, the debit side is greater than the credit side. So we will record the 12,000 on the debit side in the credit side total column as well, and then account for the difference. So the difference is going to the income statement, $750. So what does this $750 mean? It's a loss. Because see, now the disposal account is credited by 750. The opposite account is the income statement, which is debited by 750. A debit entry in the income statement means it's an expense. So that means it's a loss on disposal. That's the logic. Okay, with that we are done with part C. Now moving on to part D, we are supposed to calculate the value of Lottie's inventory at 30th April 2024. Now to do this, we have to recall some concepts. Let's recall the prudence concept. The prudence concept states that we should avoid overstating assets. So in this case, inventory is an asset. We should not overestimate inventory. And we have to use this concept. Remember, we record inventory at lower of cost or net realizable value, which is nothing but an application of the prudence concept. Lower of cost or net realizable value. Now, the net realizable value is given, but the cost, we have to calculate it. They have given the purchase price, but we have to add carriage inwards to that purchase price in order to get the cost. So let's calculate the cost. For type A, it's 14 plus $1, which is 15. For type B, it's 17 plus 0, so it's 17. 21 plus 2 for C, which is 23. So we have these values. Now we have to compare cost with net realizable value. So for type A, cost is 15, NRV is 20. So the cost is less than the net realizable value. So we should record type A on cost. And type B, 17 again is less than 24, which is the net realizable value. So you record 17. And for type C, net realizable value is less than the cost. NRV is 22, cost is 23. So NRV is what we should use. Now let's calculate the value of inventory. So for A, B and C, let's calculate them separately. For A, it should be 15 times 60, the number of units. That's going to be $900. For type B, it should be 17 times 85, 1445. For type C, it's 22 times 30, which is 660. If you add them up, you get a total of 3005. So that's the value of inventory. Part E says Lottie pays $360 per annum for insurance. So using this, we can calculate the amount that Lottie pays per month, the per month amount. So that is 360 divided by 12, you will get $30. When you get a question like this, a question relating to accruals and prepayments, remember to draw a timeline. So the year starts on 1st May 2023 and it ends on 30th April 2024. That is done. Let's read the rest. On 1st May 2023, insurance of $60 was prepaid. This line is telling us about the opening balance. And the opening balance was prepaid. So remember, insurance is an expense. It's an expense account. And when an expense is prepaid, that means you haven't yet received the service, but you have paid in advance. It's considered as a current asset. It's an other receivable. So we can, since it's a current asset, it goes in the debit side. So we can record that opening balance on 1st May 2023 in the insurance account saying balance brought down $60. Now what does this $60 actually mean? Let's calculate the number of months. So we know that $60 was prepaid and the per month rate is $30. So if you divide 60 by 30, you will get 2 months. That means Lottie has paid insurance for 2 months in advance. So from 1st May 2023, 2 months insurance was prepaid. That means it has been paid already. 2 months after 1st May 2023 is going to be 1st July 2023. So we need this information to make sure we understand what's going on. Let's read the rest. On 1st August, Lottie paid $360 by bank transfer for the year 1st July 2023 to 30th June 2024. So they have paid for 1 full year, and 1st July 2023, we already have it in the timeline. So from that date, they have paid for 12 months until 30th June 2024. It's already paid. And we can pass the double entry for that as well. So since it's a bank transfer, you will credit the bank account because bank is a current asset and an asset is decreasing, so it's credited. Then we can transfer the entry to record the payment. So on 1st August 2023, saying bank, $360. Then we can try to balance the account and transfer the insurance expense for the period. So insurance is an expense, that means it will be debited in the income statement. And to transfer that debit entry, we will be crediting the insurance account. So on 30th April 2024, the last date, saying income statement, we will credit. Amount should be the amount that's relevant for the period. So that means the insurance expense will be the amount from 1st May 2023 until 30th April 2024. So there is one full year. That means we have to transfer 360 because that's the per annum amount. Now if you try to balance the account, you will see that the debit side total is greater than the credit side total. So debit side you have a total of 420. Since the debit side is greater, you will pass that same amount to the credit side as well and try to account for the difference. So that will be the balance carried down, saying $60. You have to record the balance brought down, which will be on the debit side. On 1st May 2024, balance brought down will be 60. You can see that the balance brought down is on the debit side. What does that mean? This implies that there was another prepayment. So it's crystal clear because the bank transfer was for the year 1st July 2023 until 30th June 2024. So 30th June 2024 falls 2 months after 30th April 2024. And the payment for these 2 months were already made. That means this was a prepayment. With that, we come to the end of this question. I hope you understood what we learned today. Thank you everyone for watching. I hope you enjoyed the video.